Welcome to the Savvy Investor, where it's our job to help you be secure in any economy. Are you planning for your future? Running out of money during retirement is the number one concern of today's retirees. Understanding how inflation will impact your spending is key to a successful retirement. On today's show, a guide to surviving inflation.
Welcome to the Savvy Investor. Each week, the Savvy Investor helps viewers just like you create and grow wealth, protect and preserve it, and distribute it in the most tax-efficient manner while alive and after you passed. Our goal is to make you a better informed investor that hopefully leads to better results, but certainly less risk along the way. You can have financial security in any economy. Today is the day you can take control of your financial future and eliminate worry about your retirement forever. And now, the Savvy Investor with your host, Michael Canet.
During World War II, you could buy a loaf of bread for 15 cents, a new car for less than $1,000, and the average house was only $5,000. In the 21st century, bread, cars, houses, and just about everything else costs more, a lot more. Clearly, we've experienced a significant amount of inflation over the last 60 years. When inflation surged to double-digit levels in the mid to late 70s, America declared it the public enemy number one. Since then, anxiety has abated along with inflation, but people remain fearful of inflation, even at the minimum levels we've seen over the last couple of years. Although it's common knowledge that prices go up over time, the general population just doesn't understand the forces behind inflation. In order to survive your retirement years, you have to understand how inflation is going to impact your spending. Today, we're going to explore how inflation works and, more importantly, what you can do to survive inflation during your retirement years. But first, we're going to take a look at the news. Our first piece comes from CNN Money, and the title is Inflation is Very, Very Low. Time to Worry. St. Louis Fed President James Bullard pointed to the Fed's preferred measure of inflation, which is personal consumption expenditures minus food and energy, and that's recently has been shown that prices are really only going up 1.3% over a year ago. Now, the Fed typically aims to keep inflation around 2% a year. Inflation at that level is considered healthy, coinciding with solid economic growth, a growing job market, and gradually rising wages. Our second piece comes from the Congressional Research Service, and it's called The Depreciating Dollar, Economic Effects and Policy Response. Now, the authors talk about the impact of a falling dollar from both sides of the equation. There are some true benefits from a falling dollar, and when looking back over the last decade, the dollar has been much like the stock market, up, down, and sideways. In our conversation today, we're going to talk a little bit more about the devaluing of the US dollar and how it personally impacts you. Our third piece comes from Charles Schwab's Real Money, and it's called The Best Hedge Against Inflation. Let's face it, gold has been dismal. Everyone who bought into the idea that this metal would somehow protect us against inflation and a central bank from printing money has been duped. Gold has been a lousy performer over the last year. While it's true that in the last 4 years, gold has appreciated about 60% in value, the fact is, stocks have doubled. So what exactly are we to do about inflation? Do we need to worry about it? Is it just limited to living expenses? What about medical? With all the uncertainties about the stock market and your retirement dollars, you will want to know how to protect yourself against inflation. You're watching The Savvy Investor, and we'll be right back.
If you're in retirement or retiring in the next 3 to 5 years, you must read Michael Canet's best-selling book, Surviving the Perfect Storm. Best-selling author and National Quill Award winner, Michael Canet's Surviving the Perfect Storm is a must-read to prepare for your golden years. This amazing book can be yours absolutely free, but you must call 800-787-SAVVY. Supplies are limited, so be one of the first 25 callers to receive your free limited edition autographed copy of Surviving the Perfect Storm. Call 800-787-SAVVY.
Welcome back to The Savvy Investor. Today we're discussing how inflation may impact your retirement. Now, economic history has shown that economies perform best with slightly higher levels of inflation, such as 2 to 3%. Low and dormant inflation translate into, well, a low and dormant economy. So is inflation too low at this point? Doesn't really feel that way now, does it? Not when we see the gas prices that seem to go up every week and food prices that constantly stretch our budgets. If inflation is really running around 1.5 to 2%, do we have anything to worry about at all? When will the Fed's printing of money? After all, we are basically in QE4. When will that printing have an impact on inflation in the future? If we remember the 70s and the havoc that inflation and hyperinflation caused, you'll want to stick around today for an informative topic. Today we're joined by Michael Ashton. He is the Chief Investment Officer of Enduring Investments. They are one of the nation's foremost experts on inflation, the causes of it, but more importantly, how to protect yourself against it. Michael, welcome to Savvy Investor.
Thanks very much.
So one of the things I want people to understand is as they're thinking about the future and their retirement dollars, I want them to understand how inflation is going to impact them, what the things they need to be concerned about. So let's start with some of the basics. Let's start with CPI. What does it mean? What's CPI-U?
Sure. As I think you said earlier, the inflation is really talking about how the prices of things you buy change over time. And so the CPI, the Consumer Price Index, is one of the ways we measure that. And the way that we measure it, the Bureau of Labor Statistics sends out hundreds and hundreds of price testers, and they go every day and they measure thousands, tens of thousands of prices of everything from piped gas to steaks and gasoline and everything.
Yeah, we get calls. We're part of that process. We get calls about the cost of our services.
Exactly.
Right.
And then they aggregate each of these into indices. So you can find out, for example, what the cost of steak in Baltimore is over time. You can look at a price index of that. Then they put all these indices together in ever larger and larger groups until they get to 8 major groups: medical, housing, apparel, all the big things. And then those 8 major things they put together to become the CPI, and they're weighted like an average consumer would consume. So it's mostly housing, a lot of transportation, a lot of food, and they put all those together, and that represents a price index, the price level for an average consumer. And then by watching how that price level changes over time, then we can see what inflation is.
But so, you mentioned food and stuff, but isn't there a measurement that doesn't include food and energy because they think it's too volatile?
That's right. So when you start talking about policy, or you're talking about doing econometric forecasting, what you really want to know is I need a stable measure of inflation that isn't going to move around, that doesn't have so much noise I can't tell what the overall trend is. And it turns out that 2 of the most volatile components are food and energy. And so one of the ways that economists will look at inflation is core inflation, which is CPI x food and energy. There's some other ways to look at the same concept, but that's the most common one that we hear about. We don't look at it because we don't care about food and energy, just because from the standpoint of forecasting, it's easier to deal with that concept.
To me, it seems silly not to include food and energy because for the average consumer, food and energy is the biggest thing that impacts their day-to-day living. Their housing costs, they don't change that much over time.
That's right.
Their car itself, the transportation, the car itself doesn't change that much over time. Their medical, maybe as they get older, changes a little bit, but really, food and energy is such a dramatic increase each and every year, and there's a direct correlation between as energy prices go up, food costs go up because of transportation. So for the consumer, we're looking at inflation, and right now it's fairly low, and it's been consistently low. And I mean, when we look at it from the perspective of giving advice, people are saying 2 to 3% has been the average inflation rate over the last decade or so. Is that fair?
That's right.
But so going forward, are we going to see increases? Do we think it's going to increase?
Sure. We think at Enduring Investments, we forecast both top-down and bottom-up. So we look at all those 8 components, we forecast those. We think that we're right on the cusp of seeing an acceleration in core inflation, never mind food and energy, largely coming from housing. We know that housing prices around the country have started to go back up thanks to the Fed. Over the last year, existing home sale prices are up 11, 12%.
But let's because it seems to me that the significant increases that we're seeing that's pulling that up to the 10, 11% are really in the retirement areas. I mean, you're seeing it, Nevada, that had dropped so dramatically, is coming back. So when we say up 10, 11%, we're talking about areas that dropped 50, 60, 70%, and now they're up 10. Right. I mean, it's parts of Florida, parts of Arizona, parts of California. Those retirement areas where we've seen the boomers go, they got decimated in 8 and 9. and now they're from that dramatic lows up 10%.
Well, but before that, they'd gone up 80%.
Oh, well, it was stupid before. It was just
they
stupid
went way
before,
up
right.
and they went way down, and
Right.
now they're up. We think that housing prices nationally are probably about fair now.
Right.
But a very volatile way to get to fair.
So no, you're saying that we think it's going to go up in the near future. Are we talking hyperinflation? Are we talking 3 to 5%? I mean, because the Fed's target is what, about 2 to 3, right?
Yeah, depending on who you talk to and when, but
Right.
roughly 2% is the target, and they measure it slightly differently. Our forecast for this year is 2.6 to 3%.
Right.
Next year, over 3%. But what we also tell investors is that all of the risks to that forecast are on the upside. We're not going to have deflation in this country. We're going to have, if the Fed's exit policy, if their exit strategy doesn't work, then what's going to happen is you could very easily get numbers to come out to, let's say, much higher numbers. Not hyperinflation exactly, but numbers that we haven't seen since the early 80s.
Well, I have a bet, and I know we're not supposed to do this, but I have a bet with a friend of mine, an advisor out of West Virginia, and it's a case of very nice wine that we're not going to see. He thinks inflation will be over 5% by March of 2014. Am I safe?
I think you're probably safe.
Safe?
There is a risk to you, but I think, especially if you're talking core inflation, I think you're pretty safe. Headline inflation, I don't know. You get war in the Middle East, you get energy prices to go up, and then you get headline inflation.
Well, let's talk a little bit. You mentioned the whole idea of the Fed and an exit strategy. Part of their strategy now is trying to push inflation, right? Because they don't want you saving, which is why they keep the interest rate so low. So, what impact is the fact that the Fed has put in? I joke around that they're up to QE 15 or 20 or something like that, variations of QE something.
QE-finity, yeah.
Yes, right. And so at this point, they've just announced that they're going to continue the $85 billion a month. They're going to continue to buy agencies. They're going to continue to flood the market with free and low, easy cash. We have to pay the price at some point. But what the Fed putting that money into the market, what is it doing? How come it's not having a more dramatic impact on inflation now?
Sure. So what the Fed did when they first started adding this money is they also paid banks not to lend it by paying interest on excess reserves. Those are excess reserves. And so it's as if they shipped a box of money, a closed box of dollar bills, to a bank, and the bank puts it in the vault, and it stays closed because they get paid rent as long as that's
Well, they were trying to build a capital reserve so that next time they goof up, they goofed up in the Great Depression, they goofed up in the 2000s, and so this was a way to protect the banks from goofing up again, or at least hoping.
They'll at least have a box of money they can crack open in an emergency. That's right. But as long as that box doesn't, stays closed, then all the Fed has to do, and there are an awful lot of boxes around, is they have to call those boxes back into the Fed. Of course, it's not real money, it's electronic money, but that's
X's and O's on a
effectively-
piece of paper.
That's right, and those are excess reserves, they're not being lent out. Now, where that can cause a problem is if all of a sudden banks want to start lending it out, and so all of a sudden lending goes up dramatically, or people start spending their money more frequently, and so the velocity of money goes up, and all those things will cause inflation to move up rather rapidly. But as long as it stays in those boxes, we don't even know it's there.
You're saying that the inflation's only going to creep back in when the banks begin lending more money? Is that what you're saying?
That's part of what causes it. What the relationship between those boxes of money and lending is essentially the multiplier.
So then how is the Fed thinking that they're going to accomplish higher inflationary pressures? Banks aren't lending money. Quite frankly, banks have the money to lend. If you want a loan and you're qualified, you've already got your loan and you don't need another one.
Right.
And it's the people on the margins that are, the 600 to 700 credit scores that may want the loan, they can't refinance or can't get it in the first place. So the banks are being very, very selective. So the money that they're going to lend out is pretty much lent out.
Right.
So how is the Fed printing more? And I know we're not printing, but you know what I mean, printing more money and flooding the market. How do they envision that to push inflation up if you're saying really it's the lending process itself that helps create that inflation in the first place?
Yeah, the strange thing is the Fed says they don't want to push inflation up. It's
really?
They want it to not go down.
Right.
Right, and so it's at 1.7, core inflation at 1.7. They don't really want it to go lots lower than that, but they also don't want to see it 3, 4, 5%. So they want responsible inflation. It turns out that the hard part, it's easy to cause inflation, just print lots of money. It's hard to cause responsible inflation. And right now the Fed thinks they're bringing us in for a nice,
Soft landing?
easy landing. Well, I guess it's sort of the opposite. It's a soft takeoff, I guess.
Clearly, we have a mess on our hands with them printing money. And, speculators are running up oil and fuel prices. There's got to be a solution for us. And I think if I'm getting ready to retire or I'm thinking about retirement, the whole notion of living on fixed income just doesn't work, not with all the silliness going on with the Federal Reserve, Congress, and the stock market. But now that we've laid out the problem, we're going to talk about some solutions. Now, when we come back, we're going to do a little bit of viewer mail. You're watching The Savvy Investor with Mike Canet. I'll be right back.
Join the host of the nationally syndicated TV series, The Savvy Investor, and best-selling author Michael Canet for this very important, life-changing workshop. Michael and his team of advisors from across the country have been helping families create and live the retirement they envision by carefully crafting a retirement income plan that can withstand any financial crisis. Michael will give you the tools you need to make sound investment choices and help you prepare for your golden years. At this workshop, you will learn more than just where to invest your money. Michael will also share tax strategies that can save you and your family thousands in tax dollars. You will learn important estate planning techniques that can help you avoid the high cost of a nursing home, as well as reduce or completely eliminate any estate tax. Now, you can join him in person for these very informative workshops. They could be the answer to creating a safe and secure retirement you deserve. Call 800-787-SAVVY to see if you qualify to attend one of these workshops with best-selling author Michael Canet, host of The Savvy Investor.
Welcome back. Today we're addressing the number one concern most retirees have, running out of money. Now, one of the key factors in having enough money during retirement is understanding the impact inflation will have on your retirement. Before we return to Michael, we're going to answer viewer mail. From Robin in Denver, Robin asks us, would it make sense to contribute to his company's Roth 401k? What about Roth 401ks?
Robin, that's an excellent question. Roth 401k can be a very powerful tool because all the accumulation is tax deferred and all your withdrawals later on when you finally retire come out tax free. So I would think a Roth 401k would be a great idea.
From Matt in Boca, Matt says that he went to his bank and the bank manager told him he should put his daughter's name on his bank account so he could avoid probate. Is this a good idea or a bad idea?
Oh, Matt, I don't know if that's a good idea. Typically, we tell people never to have a joint account with a non-spouse. You open yourself up to their creditors as well as several other negative effects. More likely, you would want to set up a TOD or a POD account or consult with your estate planning attorney about a trust.
Thanks, Mark, for all the great advice and answers. We're going to take a quick break now. When we come back, we'll resume our interview.
Remember when life was simpler? When things didn't move quite so fast and the world didn't seem so complex? Remember that? We do. And as the world around us has continued to speed up, becoming more complicated, more and more uncertain, we have managed to keep things simple, providing sound, easy-to-understand financial advice and proven solutions for the road ahead. From investments and insurance to tax reduction strategies, estate planning solutions, and guaranteed retirement income you cannot outlive, we're your single point of contact, a single call, a voice you recognize well, and a partner who will be by your side for the entire journey. We can't stop the world around us, but we can help ensure you're prepared for what's to come. For a special free guide entitled 10 Things to Know About Retirement Income, simply contact us today. You made it. Years of hard work, investing, planning, and now you're here. The long-awaited reward you spent a lifetime looking forward to. But what now? After years of growing a nest egg, now you want to manage it. Use it to fund your dreams. Make sure it lasts as long as you need it. And make sure it leaves a legacy for those you love. So what do? Wall Street continues to be uncertain, and many conservative options have all but dropped through the floor. How do you maintain opportunities for growth without risking what you can't afford to lose? That's where we come in. We are financial professionals. From investments and insurance products to tax reduction strategies, estate planning solutions, and guaranteed retirement income you cannot outlive. You've worked a lifetime to get here. Let us help you enjoy it to the fullest. For a special free guide entitled 10 Things to Know About Retirement Income, simply contact us today.
So what do you think of viewer mail?
Your viewers have good questions and your experts have great answers.
So one of the interesting things about hosting this show is that I get to meet advisors and investors from all over the country. Not only experts we bring on the show to address your viewer mail, but experts like yourself. You know, and inflation seems to be a common conversation we all have with our clients. And one of the main questions that we receive at workshops, and the questions that always come out, is about inflation and how do we protect ourselves from it. So let's delve into this, because really I want to be able to people to walk away from today's show saying, okay, look, Mike came up with 2 or 3 really good things that I should sit down and consider. I mean, I understand we can't give a specific recommendation, but still there's some areas of investments that people can look at. Now, you guys do some specific things for your retail investors, correct?
That's right.
You guys created some hedging strategies and such.
That's right. Yeah, multi-asset strategies. So the first thing I think that I would say to all investors, retail investors, everybody, is that we have to get away from thinking of regular treasury bonds as being risk-free securities, because they're not. They pay you back a fixed number of dollars, but if those dollars aren't worth anything, you actually took quite a bit of risk. And so...
Well, and it's kind of like the CD, right? I mean, you can go broke slowly.
Right. Yeah, exactly
right. I mean, it's
right.
just it's like little knife cuts. It's bleeding slowly.
It's, if you get back $1,000 and the $1,000 is enough to buy you a hamburger, then you in fact lost quite a bit.
Correct.
And so what we try to do with our clients, first of all, is to get them to think about replacing fixed rate bonds with inflation-linked bonds. Those are the low-risk securities in your portfolio. Tips, that's right.
So now let's talk about that for just a minute, because there is some risk even with tips that as interest rates are changing, the value of that bond, that tip can go up and down.
That's right.
But if you're looking at this as a longer term investment and you're looking at it as over the next 3, 5, 7 years, if inflation creeps in, like we both agree it is. I mean, we can agree to disagree how much it's going to be. Certainly better be less than 5% for my sake. But tips are a way to do it, because they're going to give you an interest rate plus inflation.
That's right.
So build one on top of the other.
That's right. You're going to get compensated for the actual inflation, as opposed to with a regular bond, they're trying to pay you in advance for what you think inflation's going to be.
Right.
And if they're wrong, you're out of luck.
So tips may be a portion of a portfolio for some investors trying to hedge against inflation.
I like to think of it as the panic room of your portfolio. You should have enough tips so that if something goes wrong, that part is going to be secure.
Okay. So what else should we be looking at?
So when you talk about the riskier side of your portfolio, what we often counsel investors is that don't think about equities as being good inflation protection, because in fact, when inflation goes up, equities tend to do very poorly initially. And so initially. In the long run, they'll keep up because the earnings of companies will keep up. But what happens first is that as inflation and as interest rates go up, equities tend to go down. They tend to discount all that bad news at once.
Well, and to some extent, as interest rates go up, people feel I want a little bit more security. So so especially middle America, they start to flee the market because they don't need the stock market for better returns.
That's
and they
right.
don't quite measure the risk accurately, but now they're leaving bonds leaving equities and going into bonds because I think they can, the 3, 4, 5% seems to be better for the risk.
And all the rats flee the ship at the same time.
Correct.
Yeah.
Right.
So what we say is, for the risky part of your portfolio, you should take whatever you have in stocks and split it between stocks and a broad-based commodity index. Not necessarily gold, but a broad commodity index. We use the ETF, the USCI ETF, which is a nice broad ETF, a broad-based commodity index. And so then you've got a strategy for the short end of your portfolio is inflation protected. The long end of your portfolio has more protection now. And then the third thing we would say is, if you are renting a home, you're fundamentally exposed to rents going up. And if you own a home, you're not as exposed to that. And so if if you rent and you're heading into retirement and you want to rent a house in Boca and you want to rent a house in New York, you should think about owning one of those homes.
At least one of them.
Yeah.
Right. So some great pieces of information. We need to take a break here. When we come back, we're going to do our wrap-up. We're going to tell you the 3 things you really need to take away from today's show. Michael, pleasure having you on today. It's
been great to be here. Thank you.
He actually has a really great book, and I was hesitant to show it on air, but I love the title, Maestro My Ass, and it really is just kind of slamming Greenspan and some of the things that he did to us 10 years ago and how it helped get us into the mess that we're in today. We're going to take a quick break. You're watching The Savvy Investor, and we'll be right back.
Like any tool, there's the right tool for the right job and a wrong tool for the wrong job. We've just scratched the surface here, and you'll want to know more about how today's conversation might or might not fit your needs. Ask about fees, surrender charges, market risk, interest rate risks, how the guarantees work, liquidity, and much more. Remember, the right tool for the right job.
Today we were joined by Michael Ashton of Enduring Investments, and he explained that inflation will have a huge impact on your future, and you need to prepare for it. Michael gave us 3 key steps to surviving inflation during retirement. The first thing he explained is that inflation is coming, and contrary to what you've heard, it's not going to be 1% to 2%, it's probably going to be 3% to 5%. Now the second thing that he pointed out is that you need to pay attention to medical-related inflation. The true numbers there are 5 to 7+%, so you need to plan accordingly. Now, the third thing he told us was to invest wisely. And I know that sounds kind of silly, but really what Michael's trying to convey is that you need to find investments that outpace inflation. I want to thank Michael for joining us today and providing us with important steps to take to survive inflation during retirement. If you'd like our free guide to inflation and retirement, a simple guide to protecting your retirement income, call the number you see on your screen. It is a step-by-step guide to help you make smart choices about your money. Give us a call and we'll send it out to you at no cost. We'll see you, the Savvy Investor, next week.